What's up, everybody, and welcome back to another exciting episode of CollectCo Connection, your one and only accounts receivable podcast. Today, I have the great honor of sitting down with my friend and colleague, Steve Gelsosomo, Senior Business Development Executive with Cedar Financial, where he's leading the charge, overseeing the success of our credit union and banking and finance divisions, working closely with institutions across the country to strengthen their accounts receivable strategies. With over 20 years in the debt recovery industry, Steve has carved out a niche specializing in corporate bankruptcy, high balance accounts, financial institutions, and international recoveries. If you've been to any credit union event lately, chances are you've seen Steve in action. He's a familiar face in the credit union circuit, always tuned into the pulse of what's happening in these tight-knit member communities. I'm stoked to have him here so that we can dig into what he's seeing in the credit union market, what trends we need to be watching out for, and how we can all keep our AR game strong. My man, Steve, welcome to the show, brother.
Thank you, Chris. Thanks for the time and having me on the show. I appreciate it.
No, absolutely. Absolutely. And in fact, super solid timing. I'm really excited to dig a little bit deeper into what you're seeing inside of this credit union world. So just in kicking things off, you've obviously been in the debt recovery space for over 2 decades. What are some of the unique challenges you see that credit unions are facing when it comes to recovering like the various types of delinquent member accounts that come across your desk? Like talk to me about what that's like.
So there's a whole slew of different account types. I mean, one isn't reflective of the other. I mean, we have auto loan deficiencies in your checking account, equity lines, mortgages, unsecured debts. So to balance all of them in the same manner is difficult for them internally. So other than the typical phone calls and emails and reach outs to your members, and again, we have to remember that they're members, they're not customers or clients, because it is a community and you're a member of that credit union. So there's a fine line that they have to really hold to in regards to not crossing that line in the sand where it becomes not a friendly communication between the parties, but becomes a little bit more adversarial.
Yeah.
And just trying to track down and keep that positive communication flow between the parties, even though you may not be getting phone calls back or responses back. It's basically you're knocking on a door and nobody's answering the door. So there's some internal frustration to the credit unions at that outset.
No, definitely, definitely. What do you think how is the evolution of an agency's ability or a credit union's, just in tech altogether, the evolution of being able to employ omni-channel outreach to different members within that community, like sending emails, using text messages and self-service portals? Like, how do you think that has helped strengthen that understanding and that membership within the community?
It's truly helped. I mean, when you have the more sophisticated credit unions, the larger credit unions that do have the internal finances to upgrade their systems to that, there's a lot of credit unions that are falling behind in that realm just because they don't look at that whole AI integration as fondly as the larger credit unions do. And I could be speaking out of turn, but that's what I've been finding. The AI is really a way to establish that direct line of communication with the credit union member that is owing money. I know it's a lot of time and a lot of effort and a lot of money to transition to a different core operating system that does that. So a lot of the mid-tier, smaller credit unions are using actual people behind the scenes that are dialing phones, trying to get the people on the phones, leaving the voicemail, sending the emails, letter series. So it's kind of a mix right now because we see a lot of the credit unions are transitioning over to different operating systems.
Yeah. Oh, I like almost like what we're experiencing in the debt collection world is there's a couple things that is one, the use of AI automation, getting to use digital communication channels. It's probably got to be a massive weight off your shoulders in terms of bandwidth. You don't have people just smiling and dialing, trying to get outreach. And the other thing that I think has been a tremendous benefit is it's 2025. A lot of people aren't talking on the phone anymore. And even to the point like getting letters in the mail, I haven't checked my mailbox in, I want to say, a week and a half. So getting to use like a text message or an email or going on to your own self-service platform, I really think it helps just because you're meeting that member at their preference. And I think that preference is a huge thing that is overlooked just in the AR world altogether is ultimately, financial institutions are looking for engagement. And the one thing that can help secure engagement is meeting those individuals at their preferred communication channel. So I think that it's just been a tremendous increase in how we're able to strengthen that relationship and make sure that they're getting the appropriate updates and the warnings to help avoid anything that could really be a tremendous pitfall for
No,
them.
you're absolutely right. I haven't checked my mail in a week either, just to segue into that. But no, the phone, the app, who doesn't have a cell phone these days or a smartphone?
Right.
The apps are prevalent on your phones. Not a lot of people open up the laptop to check an email. However, if you're astute enough, you can log into your email on your phone. But everybody receives text messages.
Hmm.
A lot of people that are losing their jobs, and again, speaking with the credit union community, they're somewhat embarrassed because of their financial situation, no fault of their own. And to go to a portal, not have to deal with speaking with somebody live and go through that humiliating, explanation
Right.
of your financial condition and be able to select a payment plan or percentage based on what was outstanding. Like you said, that goes to customer interaction, and that's what they're looking for. They're looking to drive the interaction between the two parties and use that information to better um, address the outstanding debt, but in a very empathetic manner.
Right. And dude, I love that you use that word empathetic because I think that debt recovery, if you will, whether it's third party, whether it's just an outstanding bill from a first party or an internal type of outreach, it's got a bad kind of taste, right? And so the more that you can lean into wanting to be amicable, wanting to be an ally, and really preserve the integrity of that member relationship, I feel like it goes a lot longer of a way than most people would give it credit for sure. Just
Great.
kind of driving a little bit deeper. Obviously, I know you and myself, we were just at the NCUCA conference. I looked at your calendar. You're obviously booked through the year with different credit union events. I wanted to get kind of your insight on what are some of the top concerns that you're consistently hearing from different credit union leaders in the market as it relates to delinquent accounts or just risk mitigation altogether?
As far as that goes, there's a lot of tools out there in the industry to utilize the risk mitigation. As I was saying, the larger credit unions are obviously more in line and in tune with that. The medium and smaller size, they don't fully take advantage of what is out there. Now, I know Cedar Financial, when we are brought into a credit union, we give them a whole slew of different tools to utilize. I mean, that we have that are proprietary or non-proprietary in regards to helping with risk mitigation. Looking at the financial situations of the community credit union member, look for liens, look for bankruptcies, try and clear their AR out as much as possible. So that's kind of what they're looking for. I mean, we have the ability to do credit reporting. A lot of credit unions don't like to do that, but at the outset, if they need to do it, we have that availability. So they're looking at everything, like you said, the AI, the omni-channel, the risk mitigation, red flags to pop. So they're working through the whole process, just like we do with them when we take over their business.
Yeah, I definitely noticed kind of the same trend in the evolution of technology is coming, whether you want to hop on board or not. And I really feel like those that are staying ahead of the curve, not only are they more technologically savvy, they can use, internal automations, relinquish that bandwidth, but also they're using it as a tool to protect that LTV and the integrity of the membership inside of that community. So you'd mentioned credit reporting, and so I know that this is obviously a hot topic in such tight-knit community focused style financial institutions. What would you recommend? Like, how do credit unions strike the balance between maintaining that member first philosophy, but also like taking that proactive approach, remaining firm as it comes to forecasting or delinquency management? Like, what would you recommend as that balance for them?
So, I mean, that's a fine line that's determined by the internal people within the credit union. But at some point, you have to, after you've exhausted all resources, if they tried internally with the credit unions and then they placed to an organization such as Cedar Financial, and we were unavailable to recover on their behalf, also, and it's warranted, a credit mark will draw their attention
Hmm.
if the both parties didn't get it. It can always be removed. I mean, it's not a permanent mark. So if that's what is needed to, and the dollar amount warrants it, to draw the attention to the member to pay, then that's something that ultimately would have to be accomplished. And no fault to the credit union, but the credit union, between an organization such as us, extended how many opportunities for them to come forth and rectify this situation amicably between the parties.
Yeah, yeah, no, and I think you're spot on with that. I think that that balance is really found in the credit union remaining proactive, making sure they're utilizing that omni-channel outreach, meeting the consumer at their preference, giving them more than enough lead up or ramp up time, if you will, to go like, hey man, look, I don't want to do this. I don't want us to be in this position. I want you to work with me. But if we continue on this road of non-engagement, like sooner rather than later, we're going to have to switch over to the other side. You know, having that type of, again, that genuine approach, like you had mentioned, it's really going to preserve that integrity. And so I would like to see more credit unions kind of lean into that rather than just have like a rule by fire kind of assignment when it comes to assignment to a third party agency. And kind of like following on this road of maintaining that balance and how these credit unions can be proactive, what are some of the early warning signs that credit unions should see, or that obviously that you're seeing when it comes to a member who might fall delinquent as it relates to like a risk of a charge off? Or what are some of the things that proactively they could look at to forecast whether or not somebody might fall delinquent, propensity to pay, if you will? What are you seeing out there?
So, in speaking with a lot of the credit unions out there, I mean, a lot of them are very sophisticated with their internal tracking devices. So they could see if somebody over the course of the last 3 or 5 years have been logging in 2, 3, 4 times a week to check their balances or do balance transfers, from one to another if they have multiple accounts to pay their bills, and that is either heightened or reduced off whatever the average is. I mean,
Mhm.
that's a telltale sign. I mean, I know, back in the early days when I always was running a negative equity, I knew I was short. So
Yeah.
there's no need to
I
log
don't
in.
need to pop in there right
Yeah.
now. I know what it's going to tell me.
Yeah. It's going to say you need more money. But that's one of the telltale signs. Paying, like if you had somebody that always prepaid it prior to their payment due date.
Hmm.
Now they're extending over the course of 3, 6, 9 months past, they're utilizing that 10-day grace period, or they're
Hmm.
falling outside that 10-day grace period. A lot of people know that credit reporting won't start until after possibly 30 days past due or 60 days past due. So if they
Right.
start to really push that envelope, there's another red flag. So there's other reasons and ways to track it, but those are probably the most right now that the credit unions are, if they are tracking at all in that
Yeah.
manner.
No, that's really interesting. I guess I didn't even think about it that way. Is there's a lot that you can tell in terms of forecasting just by any changes in activity that you see from any individual member. Going back to you saying, if they are logging in frequently, or if you're seeing a higher frequency of like, forwarding money out or seeing new money forwarded in, that's kind of off kilter of their regular schedule. I think that some of those things could also be potential triggers that could be identified internally to go, hey, look, they've broken the standard threshold of what they're experiencing in terms of logging in and how they're managing their money. So this could be one that we want to keep our eye on. And it's crazy that you could almost get that level of detail just by seeing what those activity trends, whether it's going up, whether it's going down, really spell out for you. So I mean, I guess I didn't really think of it that way, but
It's a
you're spot on.
precursor to what's coming
Yeah.
potentially.
And no, it definitely is. Look, I know you got another meeting coming up, so I'll keep it short, but I did want to get your insight on one more thing. And this is just kind of an advice perspective. How can a strategic recovery partner, a debt recovery firm, how can they actually strengthen member retention and trust rather than damage it? Like, what should credit unions look for when they're evaluating who to look with? Like, what are some of those things that really should stick out in terms of your debt recovery management that go, gosh, these guys are member centric. They really are member focused. What are you seeing?
So first and foremost, the obvious is pick someone that has a good historical dealings with credit unions,
Hmm.
such as Cedar Financial. I mean, so we handle all our credit unions independently as far as a case by case as credit unions. We customize our content to make it very customer centric to them. Our agents that we use are educated and credentialed in the credit union space. So we wouldn't take a heavy commercial collector and have them making calls or reaching out to credit union community debtors. It's a different animal. Our content right off the bat is very empathetic to their plight, where some of the other agencies may just come at them like a bull in a china shop and offer 80% reduction on the demand amount. I mean, where Cedar Financial goes after the full amount plus any applying interest or fees, collection fees that can be applied if the language is in the contracts. So don't think that a percentage of the liquidation that we collect, our commission fee, is the baseline to use when making a decision as for a credit union to go with someone, because cheaper is not always better. And if you want to maintain that relationship between the credit union and the credit union member, you have to make it a smooth transition. And sometimes the credit unions don't have enough bandwidth internally to really keep the ball on track. So going to an agency that has that bandwidth, that has that insight in regards to dealing with the credit union member is a huge success.
No, for sure. And I mean, even at that, I think that you kind of take us full circle with kind of where we started, just with respect to what were some of the unique challenges that are being experienced. Is look, man, it's not a one size fits all approach. I think that having something like a communication and engagement team that is customizing new templates for reminder notices, demand notices, the lead up to potential consequence with credit reporting, if you will, crafting a very specific and unique to your credit union client or outfit is so essential. And again, I think you made another really good point is, for commercial world where there's high probability of potential litigation, there may be higher balances. Sometimes you do kind of need a shark out there. Not to say that you don't start out with the intent of having a people first approach, but if you're met with fire through and through, you got to exercise those tools to be able to escalate. Well, in the same measurement, a lot of times, look, nobody wants to be in debt. Financial hardship is running across the entire nation. And to your point, going back to the activity on a platform, is that somebody might be geared up with a credit union for years, and it's family, it's generational, but now, today, they've hit a slump side. And so your ability to have that, first of all, the historical understanding of where they've been, growing into where they are now, and wielding that into your strategic approach, whether it's internal or by the time it does come to a third-party outfit like Cedar, all of those moving puzzle pieces are essential because, look, man, our one goal is we want to resolve the account. We want to get you back to a solid base with the credit union, and we want you to continue to benefit off of the luxuries and some of the positives of you being in that community have given you across all the years. Like, times change. And so having that understanding, being genuine, having more of a soft approach, and working with some of those consumers as allies, I feel like is really the difference maker in what some of these credit unions should be evaluating when they're looking at a new debt recovery partner.
Yeah, I mean, it's all about relationships. It goes both ways between the credit union and us with them, and then also with their.
Yeah, no, 100%. So anyways, I know that I even tipped a little bit over time. Apologies for that. I'll let you get going. Everybody who's listening, I'll go ahead and drop all of Steve's information. Surely enough, if you are a part of a financial institution, if you are working with a bank onshore, offshore, and if you are a part of a credit union community, not so much as a sales pitch, but you just want to pick his brain, get a better understanding at some of the things that you guys should be looking out for when you're making sure that you're partnering with a secure and experienced and a worthy agency, reach out to him. All his contact information is below. My man, Steve, appreciate you hopping on the show with me today, brother. Hoping to see you again real soon. All right.
Thank you for your time. I appreciate it. It was fun.
Cheers, Steve. Thanks, man. Bye.
Bye-bye.